for webinars, not just generally speaking, since of course the pandemic hit the States, but especially today for some reason. So you've chosen us over some other really strong options. So we do appreciate that. And we do hope that today's session will be helpful for you. So I will let Tisa introduce herself here in just a couple of moments. I've been working in higher education financing for 25 years now as of February. So it was kind of nice. My company posted my anniversary on LinkedIn, and it makes you feel a lot older than you feel. But I've been doing this for quite a long time. And the one thing I'll tell you is that there's so much to it that don't feel bad if you're confused or there are aspects of student loan repayment you don't know. What we really want to make sure we cover today is the fact that there are certain questions you should be asking, certain general topics you should know about, but then perhaps most importantly, Tisa is going to share some resources at the end of today's deck to show you where you can go to get more information. And that's what's really important. Have enough of an understanding to be able to go out and get the answers you need to successfully repay your student loans. And we look forward to helping you with that here today and moving forward. So Sue, I know that we have, and let me see here, this is, there we go. All right, so we've got some objectives here. I'll let you take a look at that slide while Sue cues up a poll for us. But we are, of course, going to cover just the general ins and outs of successful student loan repayment. We really want to help you understand the options that are out there, and that includes not only flexible repayment options, but specifically income-driven repayment options, including student loan forgiveness. And we're going to look at some case studies here to help you think about how you choose a repayment plan. But what we do want, first and foremost, is to ask you a poll question here. And Sue, I'm not exactly sure how this works. So there you go. Okay, you got it pulled up for us. So if you could answer the poll here for us, if you don't mind, how much stress are your student loans causing you? None, some, or a lot? And we'll give you a moment there to answer.
Thanks, Patrick. We have about half the people so far, so just another couple seconds.
Very good. Okay, we got about 3/4 of you have answered so far. And looks like we've got something up there in the more section as well. I don't know if that's something you can see there, Sue. Let's check that. No student loan.
Right.
Okay, interesting. So maybe you're attending today to help others that have student loans, which is great. Certainly train the trainer sessions are really important. Tisa and I can't reach everybody. So the more people we can help so that you can go out and help others is certainly appreciated. So, okay, so here are our poll results. A few of you actually are not experiencing any stress repaying your student loans. And I tell you, that's great too, because you know what? My office here, which is a little blurred out behind me, is in a financial advisor's building. And the one thing we always talk about is even if you're not experiencing any financial stress now, the people that don't experience financial stress, even down the road, are people that put a plan in place. So even if you're not feeling stressed about your student loans today, but you want to learn more about student loan repayment, well, good on you, because that means you probably won't get to that point, or hopefully will not be at the point where student loans are causing you some or a lot of stress. And by the way, if you're in either of those categories where you say, gosh, I am awfully stressed about these student loans, it's really causing me a lot of difficulty, we don't want you to feel bad about that, because that's actually what most surveys show, is that the majority of American borrowers are experiencing some stress or significant financial stress in repaying their student loans. In fact, what we're seeing is that more and more Americans are delaying important life and financial milestones, specifically because they're trying to handle their monthly student loan payment, and it's not putting them in a position to manage their other financial obligations, or perhaps plan for other financial obligations, which a family certainly is, a house certainly would be, or even planning for and saving for retirement. So you're not alone. But we hope we can help you with some information here that will relieve some of that stress. And the most important section of this presentation really is coming up right now. And Tisa is going to be covering this for us. She's going to talk about some of the different repayment plan options that are available. So make sure you get a pen and pad out, take some notes, ask questions. I'll monitor that chat box. With that, Tisa, I'm going to turn off my camera and microphone and hand it to you.
Great. Thank you, Patrick, for the introduction. Let's dive right in, because I know it's the lunch hour, and we'll get into talking about how to develop your student loan repayment plan, excuse me. All right, the first thing that's important to understand is the timeline that's associated with your student loan repayment, because that way you can develop a plan. Assuming that you have just graduated or recently separated from school, then your repayment timeline is going to start ticking immediately. The first thing that happens for those who are first-time borrowers who are leaving school by way of graduation or withdrawal is the grace period. The grace period comes immediately after graduation or separation, and the grace period is typically 6 months. And during that time, you're basically given the space to get your life together, figure out where you're going to work, where you're going to live, develop a budget, and choose a repayment plan. Once that grace period has run out, then your repayment timeline is going to go on for as long as you choose for it to continue. It's until the balance equals zero. But what we're going to see today is that the road to a zero balance is different for every borrower. That's why it's so important for you to choose a repayment plan that fits your finances and your loan portfolio. So let's move to the next slide. Right, so here are 4 steps to developing your personalized repayment strategy. The first one is to know your loan portfolio. The second step is to locate every applicable benefit. The third step is to set your repayment goal. And then finally, the fourth step is to choose a repayment plan. So let's go through each of the steps. The first step is to know your loan portfolio. If you've taken out federal student loans, then the best place for you to go is studentaid.gov. You'll be able to find a record of every federal loan that you've taken out in the past from multiple institutions at different times. It doesn't matter. If it's a federal loan, you'll be able to find it at studentaid.gov. If there are some other loans in your portfolio that did not come from the Department of Education, you want to reach out to the lenders or servicers for each of those loans. Loans that are outside of the federal government are called private loans. They're offered by banks, other lenders, and again, you'd have to deal with that particular lender to get information on those loans. If you want a complete picture of all of your loans, the best place to go is your credit report. And we've listed annualcreditreport.com as a place where you can go to get a free copy of your credit report once per year from each of the bureaus, and you will find your federal loans and your private loans. I will say that in some cases, I've seen people get their credit report and they don't recognize the loans. Sometimes disbursements are lumped together, so the amounts might not be familiar. Or if you've taken a pause between undergraduate or community college study and returning to school, you may not remember the amounts exactly, but your credit report is going to contain everything. And before you can truly address building that effective strategy, you have to know every loan that you've borrowed. So let's move on. Right, I just wanted to show you all a sampling of the items that you can complete for free at any time via studentaid.gov. You can apply for loan consolidation, which would take some of your older existing loans, pay them off, and create one new loan. You could also apply for an income-driven repayment plan, which would base your payments off of your household characteristics. And we'll dive into what it means to be on an income-driven repayment plan in just a bit. You can also get help with public service loan forgiveness, which allows borrowers to have a portion of their loans or the remaining balance of their loans forgiven after a minimum of working in public service and making payments for 120 months. So if you take a look at the list on the left, you'll see that you can apply for loans. You can apply for consolidation, again, the income-driven repayment plans, and get help for forgiveness, all at studentaid.gov. So if you're seeing ads for people telling you, say President Biden's going to cancel all of your debt if you just pay this company a fee, or anything that's bombarding you with a promise that sounds too good to be true for student loan help, you don't need to access those. You can go to studentaid.gov and do many of these things for free by yourself and without adding a middleman that has access to your very personally identifiable information. All right, let's move on. So I wanted to pause for just a moment with a loan portfolio to answer a very common question, and that's about consolidation. Many people think about consolidation because they're trying to get a better interest rate, or perhaps they have multiple servicers and they're looking for something that's a bit easier in terms of record keeping and making sure that the bills are paid every month. So we've listed some possible reasons for consolidation here. Of course, ease of record keeping, lowering an interest rate is a possibility, securing a longer repayment term, or transferring FFELP loans to gain eligibility for public service loan forgiveness. With securing a longer repayment term, I wanted to be very clear about consolidation and how it resets the clock on your student loans. In this example, you've got two existing loans here. Let's say the first loan is for $30,000, the second loan is for $40,000. If you choose to consolidate, those two older loans will be paid off and a new loan will be originated for the total of the two loans, which is $70,000. Once that $70,000 loan has been originated, this is a new loan, there's a new clock. So it's possible that by consolidating your loans that you're going to end up paying more overall because you reset the repayment clock to zero. But for some people, even still, it may be attractive depending on how much you owe if you have FFELP loans, or which are those older federal government loans that are currently ineligible for public service loan forgiveness. As for lowering the interest rate, this is something that you may see when it comes to private lenders. With federal student loans, there will be no interest rate savings. The interest rate on a new consolidation loan will be the weighted average of the interest rates on your older existing loans. So if you're looking to save money on federal loans, consolidating through the federal government is not going to bring you those savings in the form of interest rate savings. If you're considering moving to a private lender, it's very important to remember that once you go from federal to private, you will lose the benefits that come along with federal student loans, like the benefit of possibly having your loans forgiven through public service loan forgiveness, the options for pausing your payments or choosing different repayment plans do not exist in the same fashion with private lenders. So be very careful if you are considering consolidating that you truly know what you're getting into if you're just going to move on account of the possibility of obtaining a lower interest rate. All right, let's move on. Wonderful. So once we know our loan portfolios, the second step is to locate applicable benefits. And this list here is not all inclusive, but these are some of the larger forgiveness programs that are out there. For federal loan forgiveness, we've got public service loan forgiveness, which I mentioned before, teacher loan forgiveness, Perkins loan cancellation or forgiveness. With public service loan forgiveness, again, this is something you can find information for at studentaid.gov. The application is available, the instructions are there, but in a nutshell, for public service loan forgiveness, you need to pay on an eligible repayment plan, you need to work in a public service career, and you have to have direct loans. If you have all three of those things and you work in public service for a minimum of 120 months, then you can apply to have the balance of your loans forgiven tax-free after that 10-year period. You don't have to stay with the same employer. You just have to stay in the realm of public service. And we'll talk more about public service loan forgiveness a bit later. For teacher loan forgiveness, the requirements are in the application are available at studentaid.gov. But with Perkins loan forgiveness, the information is available at studentaid.gov, but the best point of contact is the school that you were attending when you borrowed the Perkins loan. Outside of forgiveness, there are other benefits that are available to student loan borrowers. At the federal level, there's a student loan interest deduction that you may be able to claim when you file your personal income tax return. At the state level, Maryland is fortunate enough to have a student loan debt relief tax credit. This year, I believe the amount of that credit is around $1,200, but it depends on whether you went to school in state or out of state. But again, that's a sizable benefit. It's a dollar for dollar tax credit, and the application is available for that credit every year through MHEC, which is the Maryland Higher Education Commission. There are also repayment assistance programs offered by the state, many offered through MHEC. You can check with your employer to see if there are benefits available that are specific for student loan borrowers. And in some small instances, you may find that your school or your institution has loan repayment assistance programs. So you want to dig into their website and see if any of those benefits are listed or contact the financial aid office. But the point is, there are plenty of benefits available. You just have to seek them all out and see which ones apply to you so that you can maximize your use of them. All right. Next, step 3, which is to set your repayment goal. Of course, the ultimate goal is a zero balance. We all want to get there, but the journey for every borrower is different. And there are plenty of repayment plans available, but I like to frame them around 3 options: fast, forgiven, and forever. And so the question that you have to answer is, how do you envision getting there? If you want to take the fast route, that means that you're going to pay the least amount overall, but the highest amount every month in the short term. I'm going to skip to the other extreme, which is forever. If you're going to stretch this out to the longest possible period, that means that you really are looking to pay the least amount every month. Perhaps you have competing obligations and you just right now can't afford to pay a larger amount out for your student loans. If that's the case, you'll pay the least amount every month, but you just have to be aware that taking longer to pay means usually you're going to end up paying more overall. In the middle, there's what I call forgiven. You're going to pay some of the balance and you're going to rely on those benefits of forgiveness to have some of the debt canceled. But with each of those goals, there are benefits and drawbacks. For the FAST plan, you pay the least amount overall. The drawback, if any, is that it requires you to make the highest monthly payment. And the earlier you make that payment, the better, so that you can attack the principal early on. As for forgiveness, you're going to pay some, have some forgiven. Forgiveness, for some people, they're kind of uncomfortable banking on that. It's a matter of law, it's federal law, but it means that this program is linked to legal stability over time. I've heard murmurs of public service loan forgiveness being changed for several years and nothing has happened, but that doesn't mean that change is not coming. We'll keep an eye out for it. If changes are going to be proposed, I recommend that this is the time for you to advocate for yourself. If you want public service loan forgiveness to stay around, or any other program for that matter, you have to reach out to your elected officials and let your voice be heard. If you do not pursue public service loan forgiveness, there's still cancellation benefits that are out there, but they take longer to achieve and they also come along with a tax burden. So in the year that you earn that cancellation, that canceled amount would be treated as taxable income. The last potential drawback there is that if you're looking for public service loan forgiveness, that could temporarily restrict your career options or your employer options. The goal is not necessarily to stay with one employer or in one type of job for the entire 10 years. You just have to stay in the realm of public service. And that's if you're interested in public service loan forgiveness. As for forever, you're going to pay the lowest amount each month. And while that may be convenient on a monthly basis, stretching out the repayment term by paying that lower amount every month means that you're going to pay the highest amount overall because you're dragging things out for as long as possible. But sometimes that's what's feasible, so no judgment there. I saw a quick question about the slides, and yes, we'll make the slides available to the participants after the presentation.
And I do apologize, Tisa, that I did realize as I'm trying to monitor the chat box here that whenever I pull it up to see if there's a question, I'm throwing that little box there in the screen since I'm sharing the slide deck here on my end. So no I apologize for that to the attendees. And just quickly, the question about private loans, let's hold off on that if you don't mind, so we don't redirect the conversation while we're talking about the 4-step plan that Tisa has here. But we will come to that as soon as Tisa wraps up her section. We'll get to you as well. Thanks, Tisa.
Thanks, Patrick. All right, so let's move on. Okay, so when it comes to step 4, this is when you're finally going to choose your repayment plan. If you've ever visited studentaid.gov, you've seen that there are a ton of repayment plans available. And sometimes looking at the plans, that list of plans can become intimidating. So I'd like to first look at the types of repayment plans in 2 categories: balance-driven plans and income-driven plans. Your balance-driven plans are the plans that are based solely upon how much you've borrowed in student loans. And then based on that amount, you can decide whether you want to pay in 10 years, 25 years, or if you've consolidated, you may be able to get a repayment term of up to 30 years. But all of it is based on how much you owe. Typically, the repayment terms last between 10 to 25 years. But again, if you consolidate, you can stretch it out to a 30-year term potentially. On the income-driven side, things are a bit more considerate of your household. There are questions that you have to answer usually every 12 months. Your family size, your tax filing status, and the level of your adjusted gross income. And once you provide that information, it's going to be plugged into a formula that will basically compute how much the Department of Education believes you can afford to dedicate to your student loan repayment each month. Based on that information, your payment will be calculated and you'll be expected to make that payment for the next 12 months. Given that things are based on your income, the length of the repayment term may vary depending on your situation. And every 12 months, you're expected to provide that information again through a process which is called recertification. Recertification can be much easier if you allow the Department of Education to pull your IRS tax transcript, because they can obtain the answers to the questions and compute that payment for you and try to keep the transition period between each recertification as smooth as possible. But just remember, when you see the list of the repayment plans, do not be afraid. It's a lengthy list, but they fall into two categories: those that are driven strictly by how much you owe, that are called balance driven plans, and those that are driven by your household characteristics and finances. So we can take a look at the actual plans coming up next. Okay, so in this example, we have a borrower named Christina who's borrowed $30,000 in debt, and we're assuming she has a $31,500 adjusted gross income. I want you all to, again, please do not be intimidated by this chart. This is just for informational purposes. Your situation will look completely different. And if you're interested in seeing a comparison similar to this, you can log into studentaid.gov. Your loans will be ported in and these options will be generated for you. And before I go through some of the options, I just want to remind you that these are estimates. Life changes, especially if you are enrolled in one of the income-driven plans. Family sizes change. Your income may change. Your tax filing status may change. And all of those changes are going to affect the amount of your monthly payment. So let's take a look at the goals: fast, forgiven, and forever. If Christina just wants to be rid of this debt as soon as possible, then she would go with the standard plan. The standard plan in this case would have her paying $311 per month for 120 months. And by the end of that 10-year period, she will have repaid back a little bit more than $37,000. With her adjusted gross income, it might not be feasible for her to make the $311 payment per month, but if it is, then this would be the way that she would get rid of the debt the fastest. And it's important to remember that there are no prepayment penalties with federal student loans. So if Christina came into some money, wanted to pay down that debt early, the Department of Education stands ready to take her money at any point in time if she's game for it. Let's go to the other extreme, which is forever. You'll see forever is located next to, well, in the row of the repayment plan that's called extended graduated. A graduated plan is a plan that starts off low, and then every 2 years, the payment will rise. It's almost like stair steps. Every 2 years, your payment will rise. In the first year, under an extended graduated plan, Christina's monthly repayment amount would be $113. It looks very attractive, but the extended graduated plan has a repayment term of 25 years. That's what makes it a little less attractive. But if you're looking for that liquidity early on, perhaps this payment plan would be an option for you. So if she followed this plan, after 25 years, she would have repaid almost $55,000. And here's where you can weigh the benefits and the drawbacks of certain plans. $113 per month is definitely more attractive than $311 per month, but paying off $37,000 overall versus $55,000 overall is definitely a more desirable situation. So you have a range of plans that are out there. It's important for you to consider your finances, what's feasible for you to make a solid decision, but also remember that things change. Your servicers in the Department of Education recognize that. So if you'd like to change repayment plans, you can contact your servicer and let them know that you want to make a switch. Now, the last two rows contain income-driven plans that are called pay-as-you-earn and repay, which is revised pay-as-you-earn. You'll notice that they have the same monthly payment. They use a similar formula to calculate the payment for each month, which is $103 in the case of Christina. So with that plan, you have a low payment, but every 12 months, or if there's a shock to your income or a job change, you may contact your servicer to recertify and they'll rerun the formula. But in this instance, the estimated payment for Christina would begin at $103 a month, which is probably feasible. And in the end, she would have repaid back $20,826 with an estimated forgiveness amount of $33,177. Notice that this plan does not have a public service career. So while there is some forgiveness there, that $33,000 would be treated as taxable income. And that is quite a large burden to handle. If you look at the bottom row, you'll see the difference that's made by public service loan forgiveness. You'll see that the repayment term drops from 20 years to potentially 10 years. The total amount repaid drops to $11,533, whereas forgiveness is in excess of $30,000. These are all estimates, but it's very clear to see if you're in a public service career, that public service loan forgiveness is something that you definitely want to take a look at and see if forgiveness may be available to you at the end of 10 years. So here's where you can truly compare the difference between fast, forgiven, and forever. And if you're in public service, please make it a point to visit studentaid.gov and verify your employer status as an eligible employer for this program, and explore what the numbers look like, because there are potentially thousands and thousands of dollars in savings waiting for you. All right, let's move to the next slide. And in terms of the income-driven repayment plans, your servicer is going to let you know which plans you are eligible for. So I don't want you to try to look at a slide like the previous one and memorize all of the options that are out there. You can look at the options and how they play out with your loans via estimates through studentaid.gov. But what you're seeing here are just the different names of some of the income-driven plans. Revised pay-as-you-earn and pay-as-you-earn are the ones that carry the lowest amount for your monthly payment at 10%, never more than 10% of your discretionary income. What I would like you to take a look at, though, is the difference in the length of repayment terms. With pay-as-you-earn and no public service career, you've got 20 years of repayment before you can have your remaining debt canceled, but treated as taxable income. With repay, there's a distinction between undergraduate education, and graduate education. So if you pursued a graduate degree or an advanced degree, then there's loan forgiveness potentially after 25 years. But remember, if you go for public service loan forgiveness, that repayment term is cut to a minimum of 10 years and forgiveness is tax-free. So your servicer will let you know which plans are available to you, but these four are the income-driven repayment plans that are available. Patrick, I'm not going to go into income-based repayment and income contingent repayment. So let's move to the end of step 4, which is to choose your repayment plan. After you know your loan portfolio, you've assessed the benefits, you've set a goal, then you've got a choice to make, and your choice should be guided by what's feasible for your household, your finances, and your goals for repayment. This is definitely not a cookie cutter experience. You want to make sure that you review the portfolio and the options for the benefits before you make that choice. And also you want to make sure that you exercise your right to make a choice. If you do not make a choice, you're coming out of school by graduation or separation, your servicer will automatically enroll you in the standard plan. And for some borrowers, that plan is the most expensive and the least feasible. So exercise your right to choose a repayment plan. And if you need to change plans, reach out to your servicer to ask about the process of making that change.
Great, thanks so much, Tisa. Now, we did have one question in addition to the slide deck, and it was in relation to private loans, whether or not there are benefits on private loans or what they might be. So if you want to take that one, I will check the chat box here and see what else we have from our attendees.
Okay, wonderful. So private loans, as I mentioned earlier, they're different from federal loans. So if there are any benefits attached, they're going to be different. With federal loans, you know before you borrow what the experience is going to be, what the benefits are that come along with those loans, the interest rates, the terms, everything is set and everyone is treated similarly. With private loans, it all depends on the individual lender. So if there are any benefits available, you would have to go to the lender in order to find them. With private loans, in many cases, you might see ads, maybe the Super Bowl playoffs, you see these ads with low interest rates, and the interest rates are definitely attractive. But beyond the interest rate, you need to see what happens after that rate. If it's an initial rate, you need to see how interest rates are calculated for those loans. If the loans carry a fixed interest rate, which means once you got the loan, the rate is set, or a variable interest rate, meaning that the interest rate changes periodically because it's linked to some other interest rate or an underlying index. So take a look at the terms for the interest rates. Also, you want to make sure that you ask about provisions that are in place for borrowers who might be experiencing a financial emergency or difficulty. What are the options for a deferment? It's really important, though, that you remember it's a lender by lender kind of thing. So if you were to go to one company and they give you a list of terms, just recognize that that list from that lender is not going to be the same as what you might find from another lender. So if you are considering either borrowing a private loan or consolidating your federal loans into a private loan, this is the time when you really have to shop around and be very deliberate about making the change. I will say there's one benefit that I did not mention earlier about federal student loans, and that's that the balances can be canceled in the event that the borrower passes away. That's something that with private lenders, you want to check with the lender to see if that's the case, because I've seen some cases where, you know, people who are left behind are held responsible for that outstanding debt. So do your best, shop around, be diligent before you make that leap.
Yeah, that's a great and very thorough answer, Tisa. Thank you. And I'm going to take this second bullet point here, and then I'm going to turn the first one back to you and check the Q&A, because we've got some more questions there. We have both the chat and the Q&A. And by the way, I don't care which one you use. Just understand we'll bounce back between both of them and get all your questions answered. In terms of going off topic to discuss college planning, it's really not off topic at all. I think it is critically important that more Americans start planning for the college education years before they typically do. You know, I might have mentioned I'm here in a financial advisor's office, and so I work with some folks here that are constantly trying to remind their clients that the people who end up with the lowest student loan debt burden are the people that are planning ahead for their college education. So I think your point is spot on, is that one of the ways you can avoid excessive debt and the pain of student loan repayment is to plan better at the front end. And by the way, even if it's not a family that can start planning by, let's say, opening a 529 upon a child's birth. Listen, I'm a working class person myself. We didn't have that ability. As life went on, you know, communions, confirmations, or baptisms, or birthdays, things like this, we accumulated a little bit of money in the kids' 529s. Nothing to brag about. My son's was tapped out in his freshman year of college. I understand that. But even when your child gets to that sophomore, junior year, maybe even a little bit earlier, to start looking at scholarship options, to start looking at what a school's net price is versus the sticker price. These are all great questions that are completely on topic. They are, unfortunately, things we'd need to discuss in greater depth on a future presentation, but Tisa, I'm up for it if you are. So we can discuss that one next. So Tisa, let me turn this one over to you. Angie says she was paying into a forgiveness program each month pre-COVID, and it didn't look like the amount was going down. I've got some thoughts here, but let me turn it over to you, because I'm sure our thoughts are the same.
Okay. So when you're paying, if you're pursuing public service loan forgiveness, for many people, that means paying under an income-driven plan. Sometimes the income-driven plan payment amounts each month are too low to actually attack the principal that's remaining on a loan. So if you're making your payments and you're seeing that the principal balance is not moving at all, it could be because the payment that you're making is just covering the interest each month. But if you remain on the path, the right track for public service loan forgiveness, meaning that you know you have direct loans, you know you have that employment, and you know you're paying under an income-driven plan, which is eligible, then it's okay. I know that personally, seeing a principal balance that doesn't move down can feel a bit discouraging, but the way that public service loan forgiveness is set up, if you make sure that you are eligible with the loans, the employment, and the repayment plan that you have, it doesn't matter that the principal balance is not going down. If anything, that means that when you reach the point where you're actually applying for forgiveness and you have the balance forgiven, it could be that everything you have forgiven is principal. So like I said, if you know that you're indeed eligible for the program, do not be alarmed that your principal balance is not going down. It just depends on how much you've borrowed and how much of your payment each month is going toward interest versus principal.
Yeah, that's exactly as I expected, Tisa. We were in the same place there. And I will share this with you too, Angie. I actually just had a white paper that we wrote up through Ascendium that we released last fall. And one of the things we looked at was the simple fact that so many borrowers who entered repayment in the 2010s now owe more than they did when they entered repayment. And that's specifically because they are on these plans that TISA is talking about, where they may be covering the interest, they may not be covering the full interest. In fact, this may be something you're aware of, maybe you're not, but you can be on an income-based repayment plan and you can have a month count towards that eventual student loan forgiveness, even if the payment they determine you can afford is zero. So to put it another way, and I hope that makes sense, you can actually be in repayment and be considered successfully in repayment, even though you're not making a payment, because the income-driven repayment plans may determine that you simply can't afford to make a payment. So your balance is going to increase, and we are seeing this more and more often, especially with graduate borrowers. But it doesn't mean you're not on track, as TISA pointed out. So that's a great, great question. I appreciate you asking it and appreciate TISA's answer. And my goodness, the questions are coming fast, TISA. So I'll try and tighten this up a bit here for us. Do we make individual appointments? We will share our contact information at the end of the deck. The reality is TISA and I both have full-time engagements in our positions, which don't give us an awful lot of time to talk to individuals, as much as we both love doing it. But if you want to shoot us a note, we'll do the best we can to get you. Well, let me say, we will always answer you. We'll do the best we can to give you a complete answer. And if you really need more assistance than we can provide, we are absolutely willing to try and get you in the right place and get you to the resources that can help you. So our email addresses and phone numbers will be coming. All right, so next, you said that FFELP loans are no longer eligible for public loan forgiveness if I consolidate my loans at that time. Are they eligible? I'm not sure I completely understand the question. My guess is that when we talk about public service loan forgiveness, what we're saying is that only, and TISA, correct me if I misunderstood something here, you can only qualify for public service loan forgiveness with direct student loans. So the FFELP loans, the old bank-based loans, are not eligible. That is correct, but you can consolidate your loans into a direct student loan and become eligible. I hope I've got the question right. If not, feel free to add down in the Q&A box. TISA, anything else you want to add to that I may have missed?
Yeah, you explained it well. Just make sure that when you're thinking about, that consolidation, it's good to be a direct loan borrower right now, because there are benefits like the extension of the CARES Act forbearance, which means that payments and interest are suspended until at least the end of September this year. Those benefits aren't available to all borrowers. So beyond public service loan forgiveness, it could be useful for FFELP borrowers to attempt to consolidate their loans into a direct consolidation loan, because not only could that open the door to public service loan forgiveness, but you could also take advantage of the benefits that came from the CARES Act forbearance and the extension. And if you're interested in doing that, again, studentaid.gov is the place to go. The application for consolidation is right online. You can do it for free and at any time.
Yeah, great. Thank you for that, TISA. And by the way, in terms of the current administrative forbearance, we're going to talk about that in a few moments as well, and the impact that has on FFELP, on private, on direct student loans. So we'll get into a little bit more of the particulars there. Hopefully not too many that we just end up confusing you even more. I will certainly try to make this as manageable as possible for you. But again, phone numbers and emails will be at the end of the deck if we can help with that. So thank you, TISA. All right, next I have both federal direct and subsidized and unsubsidized loans. Will these loans automatically be consolidated? Or if one loan is really low, I'm assuming either balance or interest rate, could I pay that one off and consolidate the rest? The simple answer is yes, you can consolidate any qualifying loans you like, and you can leave others out. So for example, back when the federal direct student loan or FFELP loan interest rates were a bit higher than 5%, they were as high as TISA, 6.8%, I believe. In fact, the old FFELP maximum was 8.5%. So they could go quite a bit higher than, say, a Perkins loan, which was fixed at 5%. That was absolutely an approach that some people would take, is to consolidate the higher interest rate loans into one consolidation loan, but keep that Perkins loan at 5%. Perkins loans were often a little bit lower balance as well, to your point. You're making payments, more of the payments go towards the principal because of a lower interest rate. So you absolutely could take that approach to pay off one loan that has a lower balance, or keep a low interest rate separate and consolidate the rest. You absolutely have that opportunity. with direct subsidized, with unsubsidized loans, with loans from different years set at different interest rates. You do have that option when you consolidate to choose which loans you're going to pull into that consolidation loan. So having said that, again, Tisa, anything I missed or anything we should add to that?
Nope, I think you got it perfect.
All right, good, thank you. So let's, and I apologize, I'm not trying to talk quickly to move past your questions, but to make sure we get them all answered for you. Okay, so during the pandemic, we don't have to make a payment, but if we do submit a payment, even if it's $50, would that count towards the 120 days? And I assume you mean the 120 months. So if you're in a public service field, 120 months towards forgiveness. The answer is yes, but here's what's really interesting. And I'm going to keep this quick and turn it to you, Tisa, because you're more familiar with some of these repayment options than I am. But here's what's really interesting. You don't have to make a payment. You don't even have to make the $50. If your payment is zero, as it is right now during this administrative forbearance, the federal government has said that these months that you are in a period of non-payment, you don't have to make a payment, and that month still counts towards whatever payment plan you're on. So for example, Tisa mentioned you can be on a pay-as-you-earn or a repay, and you can have a 20 or 25-year repayment term. If that's what you're on and you don't make payments for a year, it doesn't matter. You still have, you are still 1 year closer to forgiveness. And the same if you're on a public service loan forgiveness 10-year clock, you now have gone a year closer towards that 10-year eventual public service loan forgiveness date, even though you haven't made a payment. So your answer is yes. It is still counting towards that 120 months, or would it be 240 or 300 months, but you don't even have to make that $50 payment. Anything else we should add on that, Tisa?
The only thing that I would add is for some people who have kind of looked at this pause as an opportunity to perhaps pay down principal or attack some of the interest that's outstanding. If you have something else like a savings account or a separate account that you could divert that money to, you can place the money there, park it there. And then when we find out what's going to happen with student loans when the repayment resumes, then you could make a large payment if you still wanted to. But if you're pursuing public service loan forgiveness, then your goal, or at least my goal, would be to minimize what comes out of my pocket and maximize the benefits. So if public service loan forgiveness is truly what you're going for, then there's really no incentive to make extra payments, because if forgiveness is coming, you want to maximize the amount of forgiveness that you're set to receive.
Absolutely. Fantastic. Thank you for adding that, Tisa. In fact, I'll be doing a video here tomorrow for our financial advisors in this building on just that question, because people are calling and asking, should I be making a payment towards my student loans if I don't have to? And I think we're going to need to recruit Tisa to help us film that video long distance, because that was exactly the approach we're going to take. So thanks for that, Tisa. And Angie, if you hit the lottery, just remember your friends at Cash.
Don't
be my only request. And don't forget, I don't want to put in too shameless a plug, but absolutely, we're happy to chip in for that lottery ticket for sure. Okay, glad we answered that question for you. Okay, taxable income at the end of loan forgiveness. Tisa, let me turn that one to you, because you actually raised a point that I was not familiar with, so I'm really glad you did. And let me make sure I got it right so we can reiterate it. I believe you said that if you are on a public service loan forgiveness repayment plan, at the end of the 10 years, any debt that's forgiven is not taxable if you're on PSLF. That is correct. Yes. Okay, so can you just then explain the taxable income piece with the other repayment plans? And by the way, I'll throw this in quick, Tisa, so I don't have to cut you off again. And I apologize, but we will actually give you a couple of case studies. They're going to show you this later in the deck as well. So, okay, Tisa.
Okay. So the public service loan forgiveness means basically 120 months minimum of payments, remaining in a public service career, and having the debt forgiven tax-free. If you are on one of the income-driven plans, the repayment terms can be 20 to 25 years. At the end of that 20-year period, any balance that you have remaining can be canceled, but the amount that you have canceled will have to be claimed on your personal income taxes. So if in a normal year, let's say you make $50,000 at your job, you pay your taxes through your job. Once you file your return, you figure out if you have a refund or if you owe more taxes. in that year that the loan cancellation is granted, if you had another $20,000 canceled, in addition to the earnings that you have from your job, you will have to claim that $20,000 in canceled debt as income, and it will be used to compute whether you are due a refund or if you owe taxes. So that's why the cancellation, it's a nice thing to think about in theory, but in practice, if you have an enormous amount outstanding, even at the end of the 20 or 25 years, you will, the way the law is written now, have to pay taxes on that amount that's been canceled.
Great, thanks, Tisa, and well put. Okay, so the last question we have here, and we'll get back to the deck now. I will point out as well, this is not death by PowerPoint here. Tisa really had the most important section here, so I'm going to cover a few additional points. And really, we've covered quite a few of them here in the Q&A, so I appreciate that. I just want to make sure we get to those case studies because they really show you with, again, as Tisa pointed out, they're estimates, but they're close estimates, and they can really help you frame what you may want to consider as you enter repayment. And to that point, Kelly, you graduated in December 2020. You are in a grace period for 6 months with all of your federal loans, assuming you didn't use one earlier. So as long as this is your first time entering repayment or planning to enter repayment, your grace period on your federal loans will be for 6 months. Private loans can be a little different. So if you have any private loans, they can be 6, they can be 3. I'm not familiar with any private loan provider that doesn't offer some grace period. They want to give you a few months to get your affairs in order. Sometimes you're moving back home, especially now during COVID. Sometimes people are moving out of the dorms to an apartment. Sometimes you're moving home with the parents and then to an apartment. So they want to give you some time to get acclimated, find a job, and get yourself set. So you will be in a grace period for 6 months on your federal loans. Now, you don't need to apply for forbearance because the CARES Act, what they call administrative forbearance, which has been offered by the federal government, is automatic. So you don't need to do anything about that. As it stands now, you will be in an administrative forbearance in a period of non-payment up until the end of September. The one thing that I don't know, and I can look into this for you, or I'll ask if Tisa knows, is that typically when you go into repayment, I believe you still have the opportunity to choose your repayment plan. I quite honestly do not know how the Department of Education is handling the repayment plan, and you probably did that at your exit interview, actually. But I'm not sure how the federal government is handling that. So you may still have an opportunity to choose a repayment plan before you go back into repayment, presumably in October, but the administrative forbearance will be automatic. So having said all that, Tisa, any idea, any insight, thoughts, you know more than I do about how students graduating are choosing their repayment plan during administrative forbearance?
So in the exit interview, you're definitely asked, which repayment plan are you interested in? But what you'll notice after, well, you may have noticed already, is that you start receiving more emails from your servicer. It may have been happy birthday before, but now it's you graduated. What are you up to? What's your new address? What are you doing? And the communication becomes more routine, more frequent. So they're going to reach out to you and ask you, have you made a decision about your repayment plan? So be on the lookout for those communications and do not just let them fly by. Make sure that you exercise your right to choose a repayment plan, because standard practice has been, if you do not choose one for yourself, you will be automatically enrolled in the standard option, which again is the shortest time frame, which usually results in the highest monthly payment.
Thank you. 2 last points and we'll move on here. And again, really appreciate all the engagement here. It makes it much more interesting and fun for us as presenters as well. The first, in terms of private loan refinancing, Tisa did cover that as part of the consolidation section. I'm sorry you jumped on a little bit late, but it is getting, gosh, we're at 12:50. So what I would say is this. For private loan refinancing questions, I don't know about Tisa, I'm free until 2. If we can get through a little bit more of this presentation, wait till the end. Happy to address that one for you. And Tisa, I'll leave you with this. Maybe we can cover this at the end, or maybe for you, Sue. We did have, you're welcome, Kelly. We did have a question about SAVI, S-A-V-I. If we're familiar with it, I will simply say that I am not. So I'm not sure if Sue, either you or Tisa know what we're referring to here when we talk about SAVI, capital SAVI.
You know, I've heard of it. Basically, my exposure is limited to what I've seen on Twitter about it.
Okay.
So I can't speak to it too much. But I don't know if it's an app or a website that does offer information about student loans and assistance. But again, I'm not familiar enough to speak on it. I'm sorry.
Well, and I'll tell you what, it does make me think, and we've already had one suggestion here that we cover more of the pre-college, college financing, college planning type material. Well, let me not assume you were asking us to do that, but at least you raised the point as to whether or not that's important information to cover as well. I would agree. And even the types of tools and resources that are available now for student loan borrowers to help you avoid scams could be another session entirely. So again, I'll leave that with you, Sue. I'm always willing, and I'm happy to have Tisa along with me if she's interested, but we'll put that one aside then for right now. And let me just cover a couple of quick points here, and they're really going to be recapping what we've already talked about, because it is important to know the difference between a deferment and a forbearance. I'm going to keep this real high level. The bottom line is, during a period of deferment, if you have subsidized loans, the interest will be, well, forgiven is probably not the right word. Let me put it this way. There will not be interest accruing on the subsidized loans. Whereas in a forbearance, interest accrues on all of your loans, even the subsidized portions. Now, the one real difference, because I know this gets awfully confusing and nuanced, the one difference is at a time like this, where the federal government has granted what they call an administrative forbearance. That's a little bit different. Not only has the government said there is no interest accruing, anyone who is delinquent on their loans is now brought current. So that's good news for you. And even if you're not making a payment this month still counts towards your repayment clock. So if you're on an income-driven plan, the clock is still ticking towards your eventual hopeful loan forgiveness, whether it's 10 years, 20 years, or 25 years. So this one's a little different. But typically, when you want to ask to have your payments postponed for some period of time, you want a deferment if you qualify, because the interest will not accrue on the loans. And keep in mind that if you're in school, theoretically, if you can stay in school and keep taking 6 credits until the day you're no longer with us, you'd never have to repay your loans. Of course, that's really not realistic, but the point is it is an infinite period of deferment. And again, no interest accruing on those subsidized loans. And you have some other options as well, like fellowships and rehabilitation, time in the military. Again, you can defer the loans indefinitely during those periods of time. No interest accrues. And if you need to request a deferment for unemployment or economic hardship reasons, you can get up to 3 years where those subsidized loans will not accrue interest. Here's where it gets a little tricky, and I just want this to be in the back of your mind. If you're in a lower paying field, or if you're in a field that's somewhat unstable, and you're concerned that there will be periods of employment, there will be periods of unemployment, there will be times where maybe you're making less, times where bonuses are not available, overtime's not available. You can look at deferments, but you really want to remember what Tisa talked about with these income-driven repayment plans. And here's why. If you're unemployed for 3 years and you're in a deferment, there's no interest accruing on your subsidized loans. And that's a nice perk. You know, that's not going to happen with your mortgage or your auto loans, right? It's a nice perk. But if those 3 years could have counted towards eventual loan forgiveness and you still didn't have to make a payment, that's something you want to look at. It gets a little more nuanced, I understand, in terms of the accrual of interest, but you really need to think about these income-driven repayment plans because they not only offer you flexibility, they offer loan forgiveness at the end. Again, the main drawback being interest accrual. I'm not going to get too deeper than that. Your heads are probably already spinning. We've had multiple requests for the deck because you just can't keep all these notes straight. Trust me, I went back and did some research before this session too to make sure I had some of these things straight. Unfortunately, I have Tisa to lean on as well. So we're just going to keep this high level. Again, you really want to look at those income-driven repayment plans. That should probably be your first option. And you always want a deferment over a forbearance. Now, Tisa's covered these loan forgiveness programs pretty well. I just want to add one option here, and that's teacher loan forgiveness. for a couple of reasons. Remember, we mentioned that public service loan forgiveness is only eligible on your direct loans. Now, this is where these get a little tricky as well. And there are much bigger charts than we've shown you here that would help someone like Tisa or I help a borrower determine what they might be eligible for and what the best option is for them. Because you not only have to be in an eligible field, when you talk about teacher loan forgiveness, it's more than that. You could actually be in a specific area, not just a teacher, but teaching a specific subject or teaching in a specific geographic location, and you may qualify for additional loan forgiveness up to $17,500 versus the base $5,000. Then you can look at the term. It's only 5 years of consecutive though, whereas PSLF doesn't have to be consecutive. And this is where the federal government just drives you nuts because they created all these wonderful programs to create flexibility. But because they're so confusing and so nuanced, and you see different eligible loan programs there, depending on which type of forgiveness you're looking at, it really opened up the door for a lot of these scammers to show up and say, especially on the radio, you hear it. I'm actually hearing some of them on Spotify. You need to call us today because you may be eligible to have your entire debt forgiven. And that may be true, but most of those companies are really not that worried about it. They just want to get you to pay them on a monthly basis to help manage the debt. And this is why it gets a little tricky. So again, we'll have our email addresses at the end. We can't really do the in-depth individual appointments that I would love to do. I know Tisa would as well, just because of the time commitment, but we'll do the best we can to make sure you've got the best available resources, and we put you in touch with some good nonprofits that can help. We talked about the time frame towards PSLF, so if you don't mind, I'm going to keep moving forward here. We've talked about the eligibility requirements. So again, we're going to keep moving forward. And we've covered this as well to some extent. And the certification form that Tisa mentioned, you can complete on your servicer's website. Okay, here's what's really important. And Sue, we're at 12:58. Again, really appreciate all the questions. I'm happy to take a few more minutes. Sue, is that okay for you? Are we on a strict 1 hour time frame, or can we take a few more minutes here?
If we can wrap up by 5 after, that would be great.
5 after we can do. So why don't we do this then? Tisa, I think we can probably at least just cover Oliver, and then we'll go to those resources so that we can show them where they can go if they need additional help. We'll just hopefully President Biden will cut some of those down in half. Will that change the repayment schedule? Possibly. It remains to be seen how the feds could potentially put forward some type of forgiveness plan. We'll have to see. And thanks so much. You're very welcome. Thanks for the nice comment. And with that, I'm back on mute, Tisa. Let's talk about Oliver so we can look at a couple of sample repayment options.
Okay, so we're looking at Oliver, who's got estimated income of $65,000 and a federal student loan debt of $78,000. And the question is, which repayment option should Oliver consider? Let's take a look at the numbers and how they stack up. So the first two plans that you see here, standard and extended fixed, are the ones that are based on his balance. The standard plan is 10 years. The extended fixed plan is 25 years. You can really see what that time, that repayment term does to the numbers in terms of the payment. If he takes the 10-year option, he'll pay $808 per month. If he takes the 25-year option, he'll begin at $434, but that payment will increase every 2 years. The really important piece to look at is the total amount paid overall. With the standard payment plan, that's 10 years, the same amount each month, he pays back about $97,000. When you look at the extended fixed plan, you can see the dramatic increase in interest because the repayment term has gone from 10 to 25 years. Now his overall amount repaid is estimated to be more than $130,000. If you look at the bottom two plans, repay and pay as you earn, these are income-driven plans based on Oliver's adjusted gross income, tax filing status, and I'm forgetting one of them, but you get it. This is his household. His figures are going to be used to compute the payment for the next 12 months. So in that case, if he goes with the repay plan, it would take him about 189 months. But look at the payment range. On the low end is $386, but by the end, they're estimating that Oliver will make enough money to be able to pay about $900 per month, which is more than he would pay under the standard plan. But if you take a look again at that total amount paid, if he goes with the repay plan, the repayment term is stretched out, so he ends up paying more overall, almost $115,000. The payments are similar for pay and repay, but the thing here is this. You think about those goals. Do you want to go with fast or forever? On the fast end, there are savings. He's paying $97,000, but on one of those income-driven plans, he'll still pay more than the standard plan, but he'll end up paying less than that extended fixed plan, settling at about $115,000. So Oliver's got to think about what's best for him, his household, before he chooses a repayment plan.
Thanks, Tisa. And just quickly, we have Vanessa, who is a high balance borrower, makes a good income. Let me just show you this real quickly as we get to resources, because you can also see that for borrowers that have a significant amount of student loan debt, if you do go on a pay or repay, just to look at those two bottom figures there, depending on how much you borrowed and how much you make, you could conceivably, under an income-driven repayment plan, pay less than on the standard plan, which is a little bit different than Tisa's example when she talked about Oliver here, because based on your income, you could be a high balance borrower. Maybe you have 5 or 6 or 7 in the household, so your payment's a lot lower, and you may have a significant amount of money forgiven. And keep in mind, as you see with the projected loan forgiveness here, that's over 20 or 25 years, or 240 or 300 months, whereas public service loan forgiveness, let's say those were loans from law school, and Vanessa went into public defense and had these loans forgiven after 10 years. Now that's an awfully big tax nut. That's what they call a tax bomb. But you can see just how much you can have forgiven over the course of time. Okay, Tisa, I know we're running real close. Let me let you give your closing thoughts here, because you had some great strategic thoughts for our attendees. I will just check this one comment here, make sure we can get all questions covered. So, okay.
Right. So I can hang on till about 1:10. So
okay. Thanks, Tisa.
Right. So in closing thoughts here, it's important to remember again that your repayment plan should be guided by the feasibility for your finances and your goals for repayment. It's important for every borrower to exercise their right to choose their own repayment plan, and to also contact your servicer if you feel that you need to change to a more appropriate repayment plan. Before you choose that repayment plan, just make sure that you've taken a look at your strategy from every angle. If it's going to be a sound strategy, it needs to, number one, address all student loans. If you only consider the federal and you've got some private ones out there, then your strategy might not be as effective as it could be. So make sure that all student loans are addressed. The second point is to maximize every applicable benefit from the federal level to the state, your employer. There's so many benefits out there. You've got to explore them and see which ones apply to you. Third, it needs to align with your repayment goal. And the way that I think of it, again, I've shared, is fast, forgiven, or forever. What are you looking for? And once you've done those 3 things, you want to pick the repayment plan that's going to establish a payment for you that's realistic. It's a nice thought to be ambitious and attack the debt as aggressively as possible, but sometimes those aspirations don't line up with how real life turns out. So it's better to select a more realistic plan and pay extra if that matches your strategy and your goals, than to set the bar really, really high and not quite live up to that. So just be realistic with your expectations. Make sure you take advantage of the benefits, choose a goal, and address every single student loan. And for those of us in Maryland, we have some resources that aren't necessarily available in other states. I encourage you, if you're on the planning end of this, visit Maryland529.com. Take a look at the Save for College program. As your family, you may be eligible to get a match. The highest level of the match, I believe, is a $25 contribution. And this is reserved for the households with lower amounts of income. A $25 contribution can be matched by the state with $500 towards your child's college education. So make sure that you visit Maryland529.com. Central Scholarship Bureau is another place to look in Maryland. Make sure that you get familiar with MHEC and have your students set up an MD CAPS account, so that if there are state scholarships that your student wins, the processing piece will be much easier if you have your account set up already. I also saw the student loan ombudsman mentioned in the chat. I'm gonna try to open it up and read Verbatim, yes, the student loan ombudsman. Maryland is one of the states that has one, a liaison between student loan borrowers and student loan servicers. So if you have a problem with your student loan servicer that you're unable to resolve on your own, you can file a complaint with the ombudsman. The link is in the chat. Also, the Department of Education has an ombudsman as well. Their ombudsman, there's a process for addressing your complaints or issues before you're able to reach the ombudsman, but the information about how to arrive at that point, you can find that via studentaid.gov. And one more thing in the chat is the Student Loan Borrower Bill of Rights for the state of Maryland. So please do make sure that you take advantage of those resources. And Patrick, thank you for putting up that slide with our contact information.
Absolutely.
Again, I'm so happy to see so many questions. It's good to know that there's interest and that people were courageous enough to put those questions, no matter how personal they were about your own debt, in the chat and get some answers. Hopefully those answers have been helpful to everyone else who joined us today.
Yes, thank you. And again, this is, although it went, gosh, excuse me, it's been an hour already. Although it has been my first time working with TISA, absolutely wonderful to partner with you and the team at CASH. So Sue, thank you very much for bringing us on. I appreciate the kind words. In response to that last question, no, you were on mute, so you don't have to worry about interrupting the presentation at all, though I appreciate the thought. And Sue did record this session, so I know that will be somewhere on the CASH website. I will let Sue address that. And again, with our contact information there, just remember unfortunately, we don't work in the individual planning space right now as much as I love doing that work. So if we can help get you pointed in the right direction, though, I know we're both up for it. And Sue, we've had some thoughts here for future sessions. I don't want to speak for TISA, but TISA, it's been a lot of fun working with you and getting this deck ready. So let me know how we can help in the future. It's been fun working with all of you, and I look forward to doing it again. So Sue, I'll turn it back to you, and thank you very much for having us today.
Wow, Patrick and TISA, thank you so much for all this great information. It was awesome overall, and it was great to be able to answer individual questions and really go sort of in depth as well as you did. So really appreciate this. Thank everyone for taking time out of your day today to attend this. It will be on CASH Academy within next week, so you'll be able to look at it. And if both presenters, I think they said they're okay with sending out the PowerPoint, I'm happy to do that. That'll come out through CASH Academy. I'll get the email list of everyone who attended and get everybody out the slides. So with that, we will end this webinar, and please everyone stay safe and check CASH Academy for other webinars that you might like to take. And keep in mind, we do have a financial coaching program, so you get to work with someone one-on-one if you'd like to have a little more assistance. So everyone have a great day. Thanks.